$5 a day will make you a millionaire. That sounds like a bumper sticker. It sounds like something a motivational poster slaps next to a sunset. But the math is real, the ETF is real, and the timeline is something a 22-year-old starting today can actually hit before they turn 60. And here is the part that should bother you. The $5 already exists in your budget. You are already spending it. You are just spending it on the wrong things. Not a video about cutting lattes. That comparison is tired and worn out. This one is about compound interest doing something that genuinely does not feel possible until you sit down and run the numbers. So let's run them. Start with the psychology, because it matters more than the math. Richard Thaler won a Nobel Prize in economics for his work on mental accounting, the way humans sort money differently depending on how it is framed. His research revealed something that should shift how you think about every small purchase. When you spend $5, your brain does not register it as a financial decision. It files it as pocket change, insignificant, gone without a second thought. But when someone tells you to invest $1,800 a year, your brain fires back. That is a sacrifice. That is a real amount of money. That demands a real decision. Here is the thing. $5 a day is $1,800 a year. They are the exact same number. The only difference is framing, and that framing is draining millions of Americans of their financial future. Right now, 67% of Americans say they are living paycheck to paycheck. That stat gets cited constantly, and it is usually held up to explain why people cannot invest. But look closer at where the money actually goes. The average American drops $148 a month on fast food. That is $1,776 a year, almost exactly the $1,800 we are talking about. Bank of America data puts the average monthly coffee chain spend at $45.50 per person. Food delivery apps? $179 a month. And somewhere in your subscriptions there is $15 to $20 a month bleeding out to a service you have not opened in 3 months. The gap between people who build wealth and people who do not is not income. It is perception. The people who believe they cannot afford to invest are, in many cases, already spending the exact amount they would need to become millionaires. They just do not see it that way. Make it concrete. $5 a day, $150 a month, $1,800 a year. That is your number. Now watch what happens when you put it to work. The S&P 500 has returned an average of 10.33% per year since 1957. Not in a straight line. Some years are up 23%, like 2024. Some years the index drops hard. But over any 20-year rolling period in modern history, that average has held. The last 30 years, 10.12%. The last 20 years, 11.84%. The last 10 years, 15.62%. Dividends reinvested, not a projection. The historical record. So what does $5 a day do against that record? At a 10% annual return, the long-term historical average, a 22-year-old investing $5 a day from today crosses $1 million in roughly 37 to 38 years. They hit the $1 million mark in their early 60s, right around the time they would be thinking about retirement. A 30-year-old starting today reaches it at 10% by retirement age as well. And if the market delivers closer to the 11 to 12% it has averaged over the last 2 decades, those timelines shrink further. Think about what that means. You are not asking someone to sacrifice. You are asking them to redirect the price of a fast food combo meal every single day into an account that the market will multiply for decades. That is the whole strategy. Now let's talk about the specific tool that makes this work, because the ETF you pick matters more than most people realize. VOO, that is the ticker. Vanguard S&P 500 ETF. If you remember one thing from this video, make it those 4 letters. VOO tracks the S&P 500, the 500 largest companies in the United States. Apple, Microsoft, Nvidia, Amazon, Google, Berkshire Hathaway. Buy 1 share of VOO and you own a tiny piece of all 500 of them. Instantly diversified. No stock picking. No research. No guessing whether a single company will have a good quarter. Here is why VOO specifically, and not another S&P 500 fund. The expense ratio is 0.03%. For every $10,000 you have invested, Vanguard charges you $3 a year. $3. By comparison, SPY, the most traded S&P 500 ETF on the market, charges 0.0945%. That does not sound like much. But over 40 years, that difference compounds against you. For every $10,000, SPY costs you $94.50 a year versus $3 for VOO. Spread that across a growing $500,000 or $1 million portfolio, and you are handing the fund company tens of thousands of dollars you never needed to give them. VOO's 10-year annualized return, as of early 2026, sits at 15.01%. Not a projection, not a best-case scenario. What the fund has actually done over the last decade. If you want slightly broader market exposure, VTI, Vanguard Total Stock Market ETF, is the alternative. It holds the S&P 500 plus mid-cap and small-cap companies, giving you the full U.S. market in one fund. Same expense ratio, 0.03%. 10-year return, 14.55%. The difference between VOO and VTI is not dramatic. Both are excellent. Pick one, automate the contributions, and get out of your own way. Now let's talk about the mechanism that keeps this strategy working even when the market turns ugly. Because most people get this part backwards. They hear invest every month and assume they are only supposed to do it when the market is doing well. That is exactly wrong. Dollar cost averaging means you put in a fixed dollar amount at regular intervals no matter what the market is doing. When the market is up, your $150 buys fewer shares. When the market is down, and it will go down, your $150 buys more shares at a discount. You are automatically buying more when things are cheap and less when things are expensive. You are doing the opposite of what the panicking crowd does. Removes the single biggest mistake individual investors make, trying to time the market. Studies consistently show that missing just the 10 best trading days in the S&P 500 over a 20-year period cuts your total return nearly in half. Not slightly, nearly in half. And those best days almost always land right after the worst days, when fear is at its peak and most people are doing anything but buying. With $5 a day on automatic, you never have to make that call. The money moves. The shares stack up. The market does its thing over decades. You do not have to be smart about timing because the strategy pulls timing out of the equation entirely. That is the edge regular people carry over hedge fund managers who are paid to beat the market. Most of them do not. The S&P 500 outperforms roughly 92% of actively managed large-cap funds over a 15-year period, according to the S&P SPIVA report. So the passive automated $5 a day approach is not a consolation prize for people who do not know enough to invest properly. It beats the professionals. Let's talk about access, because even 5 years ago, this strategy was harder to execute than it sounds. VOO currently trades at around $560 a share. If you are investing $150 a month, you cannot buy a full share. Under the old system, you would need to save up for months before you could put a single dollar to work. That is 4 months of contributions sitting in cash not compounding. That delay, repeated over decades, chips away at the final number more than people realize. Fractional shares change that. Fidelity lets you buy ETFs for as little as $1. Charles Schwab's stock slices feature starts at $5. Robinhood from $1. You can invest $5 today and own $5 worth of VOO. The share price becomes irrelevant. Every dollar goes to work immediately. Open a brokerage account, turn on fractional shares, set up a recurring $5 daily or $150 monthly automatic investment into VOO, and you are running the same fundamental strategy institutional investors have run for decades, just scaled to where you are right now. And here is what most people miss about starting small. The habit matters as much as the amount. The person who starts investing $150 a month at 22 and never increases it still builds $1 million. The person who starts at 22 and bumps contributions as income grows, even slightly, even matching raises at work, hits $1 million in their 50s instead of their early 60s. Starting is the hard part. The scaling happens naturally once the habit is locked in. Look at the opportunity cost one more time, because this is where it gets uncomfortable. The average American spends $148 a month on fast food. Not a judgment. A Bank of America Consumer Spending Report. $148. Against the $150 a month we are talking about, that is nearly dollar for dollar. You are one habit redirect away from the same outcome, a seven-figure portfolio at retirement, and the redirect is not even a full meal per day. Food delivery apps average $179 a month. Cut food delivery spending by less than $5 a day, move that money into VOO on autopilot, and you run the same math. Streaming services and forgotten subscriptions, the gym you have not visited since February, the meditation app you opened twice, often bleed out $15 to $20 a month per household in pure waste. None of this requires a radical lifestyle overhaul. It requires a single redirect. You are not building wealth through suffering. You are building it by scanning what you already spend and moving a small slice of it from consumption into compounding. The $5 already exists. You are already making the decision every day. The only question is whether that decision ends with a burger or with a share of the 500 most powerful companies in the world. Here is what the last few years showed us about this strategy in real time. In 2022, the S&P 500 dropped 18.1%. If you were putting in $150 a month through that entire year, you were buying at discount prices the whole time. By the end of 2023, the index rebounded 26.3%. Anyone who kept their automated contributions running through the drop captured that entire recovery. Anyone who pulled back because things felt scary missed it. In 2024, the S&P 500 returned 23%, a single calendar year. If you had $50,000 invested at the start of that year, you ended it with roughly $61,500. Without doing anything, without picking stocks, without paying a financial advisor. Just owning VOO, reinvesting dividends, and leaving it alone. That is the bet. Not that every year will be great, but that over any 30 or 40-year stretch, the index reflects the earnings growth of American businesses. And those businesses have kept growing, adapting, swapping out weaker companies for stronger ones. For over 100 years, you are not betting on the market being perfect. You are betting on it being the same thing it has always been. The engine of American economic output, over time, on average, pointed up. One last number before we wrap this up. Inflation adjusted, the S&P 500 has returned an average of 7.43% over the last 30 years. Even after accounting for the dollar losing purchasing power, $5 a day still builds real wealth at a rate that beats every savings account, every CD, and every money market fund on the planet. Your $1 million portfolio in 2060 will not carry the same buying power as $1 million today, but it will represent a level of financial security that the average American will never reach. Because they never started. Starting is the variable. Everything else is math. So here is the question worth sitting with. Not can I afford to invest $5 a day? You already know the answer. The real question is, what is the actual cost of not starting today? Every month you wait is a month of compounding you never get back. At 10%, money roughly doubles every 7 years. Delay starting by 7 years and you are not just 7 years behind. You are opening with half the effective balance. Time is the one asset you cannot buy, borrow, or recover. The only move is to use it now. Tell me in the comments, are you already investing, or is this the video that finally gets you moving? And if you have been putting it off, what is the real reason? Drop it below. I want to hear it. If this shifted how you see that $5, hit the like button. Share it with one person in your life who keeps saying they will start investing when they have more money, because now you know that is not the barrier. And make sure you are subscribed, because next week we are going into the exact accounts you should hold VAOE in taxable brokerage, Roth IRA, or 401k, and the order matters more than you think. The difference in how much you keep after taxes could be 6 figures over a lifetime. You do not want to miss that one.